Are you making the right choice when it comes to property investment? Many investors wrestle with the big question. You go for a cash flow property or a capital growth one? Sure, high rental yield might seem appealing. They help cover costs and even generate passive income. But what if I told you that prioritizing cash flow over growth could be quietly costing you over $1.1 million in long-term wealth? Let's break it down. Every property investment generates returns in two key ways. Rental income, which is the cash flow from tenants that helps cover your mortgage and holding costs, and capital growth, which is the increase in property value over time, building long-term wealth. But here's the catch. These two forces usually work against each other. High yield properties typically grow slower, while high growth properties tend to have lower yields. So what's the smarter play? Let's compare two investors, both buying a $950,000 property, but with different strategies. Investor A focuses on cash flow. Their property has a 5% yield, but only 5% annual capital growth. Investor B focuses on growth. Their property has a 3% yield, but achieves 7% capital growth. After 30 years, Investor B is $1.165 million wealthier than Investor A. That's the real cost of chasing cash flow over growth. Here's why capital growth outperforms cash flow in the long run. Buildings depreciate and land appreciates. Capital growth properties have a larger proportion of their value tied to the land. Over time, properties rarely return more than 10% in combined rental yield and growth. If you prioritize cash flow, you're capping your wealth potential. And a high growth property benefits from compounding, meaning its value multiplies exponentially over time. Short-term cash flow feels comfortable, but it won't make you wealthy. So why do so many investors focus on yield? They want immediate relief from mortgage costs. They're tempted by tax benefits like negative gearing. They're afraid of being stretched financially. But here's the truth. What feels safe today could be costing you your financial future. If cash flow is a concern, there are smart ways to manage it without giving up on capital growth. Renovate for higher rent. A simple $50,000 to $100,000 upgrade can increase your rental yield significantly. Pay down debt faster. An extra $1,000 a month in an offset account could turn your property cash flow positive 5 years sooner. Leverage equity. Use growth from one property to cover the short-term cash flow gaps in another. There are ways to improve cash flow without settling for a low-growth property. Some investors think that buying cash flow properties will help them build their portfolio faster, but here's why it often backfires. Banks don't count all the rental income when assessing your borrowing power. High-yield properties usually have lower growth, meaning less long-term wealth. Instead of chasing higher rental yields, focus on maximizing the yield of high-growth properties. Strategies like adding a granny flat, short-term letting, offering furnished rentals, etc. can help boost cash flow without sacrificing appreciation. Property investment is a growth strategy. By the time you retire, your portfolio should be cash flow neutral, meaning your rental income covers all the costs. Then you can sell properties to fund retirement or leverage equity instead of selling, keeping your portfolio growing. The key is to focus on growth first, cash flow later. The numbers don't lie. Prioritizing cash flow versus capital growth could cost you over $1.1 million in long-term wealth. By investing in high-growth properties and using smart cash flow management strategies, you can build a portfolio that delivers both short-term equity gains and long-term financial success. At Buyers Advocate Perth, we help investors find high-growth properties that align with their financial goals. Ready to start building real wealth? Let's talk.